Hello, everybody, and welcome to the USD podcast. So uh, today's podcast is our very first podcast for the USD project, and today is July 3rd. What we're going to discuss today are some of the big overviews of what we're doing. So the first one is we'll be creating this overview video of what we do, and this includes just the topics and the kind of scope of what we do. And this will be about us protecting the worker. It'll be about going through and discussing US dollar and issues that could be a challenge for there. We'll talk about cryptocurrency and how that could solve problems or introduce new problems. And then we'll discuss a long-term economic view from now until 2099. So that's about an 80-year strategic view economically. And we'll discuss the biggest, challenging, most interesting discussions. We'll talk about likely things that'll be challenging us in the economy. And we'll have very long-term strategic discussions. So we want people to tune in to the live show that'll be every 9:30 Pacific time every week. And then you can come in and see the discussion. So you'll see slides cycling through on the broadcast here, and this will be different aspects of what we're doing. So with this, you'll see that there are, with all this, there will be the slides have interviews. So we've done different interviews, about an hour-long interviews, and you'll see those in the lower right now. So these are great people who have PhDs in economics, or they're economists, or they're just incredibly smart people that have been studying economics for many years, and we have just amazing people. And so these are hour-long interviews, and we go through discussing how the challenges can happen to real-world people when inflation becomes elevated. And then we'll talk about how citizens can go navigate this. And so with the alternatives to in currencies coming, with different currencies, stable coins, asset-backed coins, cryptocurrency, so say Bitcoin that's like fiat and a fixed money supply. These kinds of things are designed to stop the money printing side of it, and so then that way the currencies don't have inflation that would come from money printing. So there's always the US dollar and things that can challenge that, and we'll talk about fixing those or how to best alleviate that side of it. Then we'll talk about other currencies, and then they may solve the same problems otherwise. We have a great Reddit, and we want people to go create a post in our subreddit and have discussions during during the discussion. We have a Twitter account. For the USD Project is the handle. And so tweet with us during the show, and your posts will show live in the live stream. So we very much want people very active here. And let's see. So with all this, we want people to go find it, and we want them to tweet about the issues they talk about. You'll see them on the screen during the podcast. We also have a Discord channel. So contact us, and then we'll want to get you into the Discord channel. So, and there we have the website is usdproject.com, and I'm testing our email address right here, so you can go have emails to us. So we have the website, and you can come to the website, see the interviews. We'll post these the podcasts on there, and then I'm going to go test our email address. So we have an email address. You can go email us if you have any questions or discussions. And that'll be on our website also. So with this, so what you'll see cycling down below is about different aspects of protecting the real citizens. So when there's inflation like 10%, what's effectively happening are we need to protect workers, because inflation effectively is a forced pay decrease. So if inflation is at 10% year over year, they negotiated their salary when they began, and the way things work is their salary is pegged in, and the it's pegged in, and when everything is increasing in cost, their rent, healthcare, student loans, buying a new house, food, everything is increasing at 10% because of inflation, then their salary is effectively getting a pay decrease 10% every year. So 10 years will go by, and that we're showing one of the slides here goes by and shows somebody today getting 20 hours, 20 hours, that's 20 hours, $20 an hour is $41,000 a year. Over a 10 or 11 year period, your costs have doubled, but your pay has not. And so that 10% inflation year over year completely erodes, and where you could used to pay with your paycheck or your checkbook or whatever and get all your bills paid by the end of the month, 10 years later after this kind of inflation, you can only pay less than half of your bills, and inflation truly hurts people. And so we'll talk about big strategic events in the future. Shock events, you'll see these right here. So one term we often call them is a shock event, and we'll go list the different shock events. So different podcasts, we're going to go do deep dives into each different kind of shock event. With the environment, the politicians might find it's very required to go make big investments that have so much money, like the Green New Deal or something else, carbon tax or something else. It could be any kind of thing, and then they might well do money printing in order to go pay for that. So money printing happened, a huge amount of money printing happened with the 2008 financial crisis. So we actually had a certain amount of money, the certain base, about a little bit over M0, was about $800 billion, and it went up to $3.4 trillion. So it increased about 250% increase in the money supply by money printing alone. And this is called the monetary base, which is about M0. So just the pure money printing at the lowest level, it had a money printing of about 250% more than what we had before of just new money printed to push in the economy. And in that case, to give to banks to put on their balance sheet to have a lower leverage ratio. So we just gave all that money to the banks, which is not okay. And then other parts kind of went through the economy to try to go backfill all the damage caused by the big crisis. But if you look back in history, money printing happens over and over and over. If there's a war, Vietnam War or World War, there is the savings and loan crisis, and just on and on and on. And there's a lot of things that we just don't see, like the long-term capital management large-scale bailout, hundreds of billions of dollars back in 1998. So there's often a lot of events that we forget about, long-term capital management bailouts, that cause money printing, and all of these things drive up inflation. So we'll go through a timeline between now and 2099, and one of my biggest shocking events is that right now we're avoiding destruction of from money printing, because when there's all the national debt has the deficit every year, the deficit goes, and it's not paid for today by money printing. It's paid for by expanding U.S. Treasury bond market. So the government bond market grows by the deficit to pay for the deficit, and that's going to work for a while. So the big shock event I found of modeling out what's going to happen over the next after about 5 years or so, there's going to get to a point where we're greatly accelerating the size of the bond market to try to absorb all of this deficit. And what's going to happen is the bond market is just going to proportionally attempt to scale way beyond other asset classes, and there's just not going to be enough money in the world for people to go buy U.S. Treasury bonds. That won't make sense financially. People don't want to put that much money into that asset class. It'll scale so big to so many trillions of dollars. There just isn't that much money in the world sitting somewhere else to go shift into that. So in that case, the U.S. government will hit a wall, and it'll have to go from right now almost zero money printing to pay off the deficit and a whole bunch of other things, that aren't paid for right now. And it'll have to just keep the bond market there maxed out and just kind of reissue bonds that got hit their end of life, and they'll get reissued to keep the bond market the same size. But for all of them, every year the debt will then go immediately over to money printing. So we'll go from this point of zero money printing to pay for the debt until this huge scale money printing to pay for the debt. And in that case, all this money will be flooded in the market, and the interest rate, the inflation rate can spike. And we'll go into that. We'll go into economic modeling, and we'll go have interviews with people on this. So that's what the USD project is all about. Is when you go look at every single American, everybody, and even other countries, when you have the country go into heavy money printing to pay for deficits and interest on the national debt and things, then suddenly inflation will spike up, and it'll just get all citizens in the country into huge economic problems where they just can't pay their rent where they could before. They just can't pay for basic food and gas bill and just the very, very basics. So we'll go through all this stuff. So with cryptocurrency, so partly, the first part of this podcast will be go over the overview, and I just did that with the USD project. The second thing I want to really shift into talking about today is we're going to be creating these videos and these slides around what I call strategy for the political left. So when it comes into currency and cryptocurrencies and different things, the right has a number of issues, and they step forward and they very much defend the right. The political right has stable money and sound money. They have Austrian economics and various things all kind of touch upon this side of the issue. So they'll talk about that side of it. But what this podcast will very much go focus on is protecting the U.S. worker, and we're going to go have a big forum to go tour all the big economic strategies, including on the left, over between now and 2099, a long-term view of economics. And we'll talk about whether it's Social Security. Social Security will have massive problems when it simply can't be paid for, when the bond market can't grow anymore. And so we'll talk about, there's things on the left that would be very powerful strategy-wise to be able to go address these kinds of economic decisions. So we're going to go have a number of our podcasts, a number of the slides and videos. We'll go over that. We're going to pull up a figurative table and have the political right and the political left sit down and have great discussions back and forth. Very much strategic, very much grounded in deep economics. And then we'll have everybody's major point economically and strategically. We'll do deep dives on all of those, and then we'll let them be lined up. And for the USD project, we don't want to push any partisan view, but we very much want to pull both sides of the world together and have a place for them to go debate, have a place for them to go deeply tour every single facet of each side of that. So you'll see that. And so one big aspect is, if you look at where the U.S. revenue, all the dollars come in from the U.S. government, tax dollars, and everything that we pull in, the U.S., they call it U.S. Revenue, so incoming money, all of it, 83% of that comes from workers. Anybody pulling a paycheck, getting paid by income. So if you look at all capital gains, that's less than 7%, or much less than 7% of U.S. Revenues. And if you look at all corporate taxes, you're talking about 10% of all U.S. revenues. So when 83% is put on workers, on income, and 10% is put on corporations, and less than 7% is putting on the wealthy living off of investments, capital gains taxes, that's way less than 7%. Then what you're dealing with is, right now, all of the loads on the workers. And so on the political left, there's really big, easy discussions to have to talk about this great imbalance. And there's things that could be solved by smart decisions, and there's a lot of room for discussion. So we want to pull on economists anybody who follows the news deeply and has studied these issues, read a lot, we want to come pull you on. We want you tweeting. We want to hear from you. We'll let you go record 3 minute your points of view, and we'll play them during the show. We'll at times pull you on for a full interview. We very much want your voice plugged in. And definitely tweet about us, even after the show, between shows. Tweet about us and tweet to other people saying, what do you think about this? So you'll be able to keep coming back to the USDproject.com website, and we'll be breaking down all of these different pages. Some on each shock event, the environment, how will we invest in that, what will politicians do, and how much will that cost, and will that print money and expand the currency supply? AOC has definitely talked about that for paying for the Green New Deal. If that happens, when could inflation rates increase? And then with all of those things happening, how will that come back? So I will start to go through a few different interesting things about what we're doing. And so I have the ability to go show my screen over here, and I will get that ready. So by doing this, I can go pull together an interesting view of this, which is my other screen here. I'll get that ready to be shown with this. Okay, so it's being shown on the screen right now, and we're going to have a Google Drive folder available publicly for read-only access. And when you go look on this, what you're going to see is this. We're going to go make a spreadsheet here, and the spreadsheet's going to go model for the next years until 2099. But we're going to have a lot of drama happen in 2025, 2030. So that's going to happen pretty soon. So what I want everyone to think about is if today, 2019, if a new baby is born in your family, as a sister, as a child, think of somebody is going to have a child that's going to be born today in 2019. So they'll start to turn one in mid-late 2020. And what's interesting is they will only be about 5 and 6 years old when a lot of things can end up happening. And we'll go through this. So what will end up happening is inflation will greatly spike because all the deficit will stop pouring into the bond market expanding. It'll pour into money printing, like pretty much overnight. When people stop buying bonds, when people we try to get the bond market to increase, and we'll try to make that grow at times. We'll get to a certain point where the bond market just won't increase because they know we're just going to start to inflate their value away, inflate it faster than the returns on those bonds. So they'll just stop investing in the bond market, and the ceiling of the bond market will just we'll have a ceiling that immediately shows up when we hit that ceiling. And then we shift straight over to money printing, so everything in the debt. And even if we tried to not stop paying on the debt, we still have to pay interest and a whole bunch of other things that'll have all this spending happen and then cause that to happen. So what we're doing is this is the spreadsheet to go model this through. So we call it National Debt version 0.2. We're going to go have this on the Google Drive where we want to hear from you. You can go write a blog post and we'll go read it. We can go tweet about us. We want to hear people make different points. Pour through it, analyze it, come up with their opinions, make a copy of it, change that, point that back to us. And we're going to go find out people make great insights, great advances. And we'll go have debates on those and discussions in those in the podcast here. And then we'll roll those back into the version 0.3 and then version 0.4. And so it's very early, but it's designed to have a way to scroll through and be able to see the big inflection points. So this one right here, and I'll give a kind of a quick tour of a few pieces of this. And so what's happening is you have the U.S. tax revenues right here, how much we pull in by taxes and any other means, and then you have U.S. expenses. So if you look at right here, let's take the current year right now. What we're talking about here is we pull in revenues and then we spend more, 700 billion more. So when we're spending 4 trillion, and we take in 3.3 trillion, we got 700 billion there gap, and that goes into the deficit. And so right now, if you look over here on the national debt will grow because we got to pay those bonds back. And then if you look over here on, we call buyers of bonds. So once we have things we need to go pay for, then you end up having these bonds that need to be bought, and then you'll have the U.S. bond market increase. So, and right now we're paying like 2.5% on interest on the bonds, on the treasury bonds that we end up doing. So here is the monetary base. This is $3.4 trillion in economics. They call it the monetary base. That's M0 and a few little things, but it's much smaller than M1. So what will happen here over time, and we're kind of going to go show out to 2015, and we'll have the different debates on how much can the bond market absorb until that shuts off. How much will we get to a certain point? We got to keep ratcheting up the interest rate. We'll have to start to go ratchet up to 3.5%, 3%, 3.5%, and that can escalate up to 10% over time. So we'll figure out what that is. But we want debates by economists and different people to talk about and really pour over the spreadsheet and start to go find out when will things hit different times on the timeline and different amounts of money before the mod market is going to demand a higher return before they keep allowing some more the bond market to grow in size. And then at what point is it likely to go hit a cap because we just can't increase interest rates higher, or there's just no more money to shift over to the bond market. So we'll go through that discussion, and then what will happen here, and in this tab, it's showing that at 2016, as we shift into 2016, when we have this gap, we'll shift over, instead of it just increasing the bond market, we now have to pay for that interest on the national debt and the U.S. Unfunded obligations, and our deficit will shift into money printing. In this case, we're talking about the monetary base increasing. So once that happens, what I found shocking is when that happens, it could easily be that the monetary base grows from 3.4 trillion to 12 trillion. That's a $9 trillion increase. And we'll go into this. So when the increase gets really big, it'll come back to what the inflation rate will be. So there's one really big discussion we're going to go talk about, and that's right here. So this right here is going to be the biggest discussion we open up right now. We want people tweeting back and forth, having discussions on this, and later we'll go point out economists. And so what happens is we have our national debt, and then we have to go pay interest on that national debt. So if you go look at the interest on the national debt, that's going to be that certain amount of money, and then that'll be expanding in the bond market to pay for it, and eventually off to printing money. Now, the other aspect over here is $180 trillion. And if you add these two up, it's $202 trillion of U.S. national debt plus U.S. unfunded obligations. And so we'll give clarity on what this means. This right here is such a gargantuan number. It'll change the discussion, and we'll have big debates about this. So I'll give a peek into what that is. And what that is federal workers have their retirement, and military workers have their retirement. And then when you come to Social Security people paying in their Social Security for retirement, they're working now, and they've been paying in for a decade or two, and it's going into this fund, and then there's also Medicare. And so the number of, mostly it's Social Security, Medicare, U.S. government workers, federal workers, and military workers. So when all of them have been paying into the system, that money, the government sucked it out the back door and spent it off on the stuff during many years ago. So if it came in 8 years ago to be saved for their retirement, it was sent out the front door and spent for various things. Then the political left will hate when it's spent on military, maybe, and the political right will hate when it's spent on a number of things. So when all of this happens, um, that all turns into the U.S. Uh, government's debt, unfunded obligations, because those military workers will end up retiring and they gotta get paid. They put money into their retirement and it's gone, and now it has to come back and get paid there for their retirement. Federal workers, and there's a lot of U.S. federal workers. It's a couple million, and then all the retirement they paid in, they worked hard for decades, and they got to get their retirement paid back. That's part of this number. The other, Social Security people have been paid in for decades. They need to get their retirement, and that'll be this. So the interesting part about this is we're going to have debates on what this number is, and this is one of the numbers I heard, and this gets a little bit complicated because people talk about it kind of coming back into the current present value. So we'll go into some economic discussions on how that's calculated, how big it is, how small it is. Do we have to pay the key right here is going to be, do we need to pay like a 2.5 kind of interest? So when federal worker, military, and person paying into Social Security, when they pay in, when we finally get the money back that they paid in, since they put it in the fund, put it in the treasuries, they really should get their interest back on that. If they do, then this number over here is going to include the national debt, that year amount within the bond rates returns have to be paid on that, and then whatever the obligations are. So we'll make sure to get this number right. It may be very off right now. I'm actually looking for economists to go slice and do a deep dive on this. We're going to probably wholesale replace the K column. If you're out there, please ask economists to give your opinions. Please point people our way. We want people to go do analysis and a deep dive on this. We're going to wholesale replace the K volume with what people say is right. And we want a lot of opinions on that. And we're dedicated to make sure that that's done right and it's not in any way politically skewed. So with that, then the other discussion will end up being, do they really get stiffed in never getting paid interest, whatever the right amount is? Then since they put the money in, they'll need to get that paid back because they need that back later. And then they put it, since it went into their trust fund, and it's kind of disappeared into IOUs. When the IOUs get paid back, since they were technically in U.S. Treasuries, they got to be paid back the interest rate. So then that comes and impacts over here. Here's the interesting part is, once things come out a ways, we're going to have an inflection point where U.S. federal workers are come along and say, hey, we're getting to the point where we're going to have big inflation, and we're going to go stiff people who bought the national debt. China, Japan, a lot of people in the United States and their retirements in local districts and things. A lot of local teachers, local employees, their retirements are tied up in the treasuries and things. So whenever we try to go do heavy inflation to just deflate the value of of treasury bonds and really stiff everybody holding treasury bonds, when that happens, what's going to happen in Social Security and federal workers, military workers, they're going to absolutely demand and say, having our money disappear into IOU treasuries, we're going to demand that back, and we're going to demand that get shifted over to another investment asset class, which is real, which has a real value there, and it's going to get a real return every year. So what's interesting here is, once this big wake-up call, which I think is going to happen in about 6 years, that's pretty fast. That's more than 2 presidents away. So we're two election cycles away. So what will happen there is, when all this money printing happens, then the shift of all of this will happen to the interest will have to be paid. So whatever this column ends up being, the interest rate will end up having to be paid immediately when it otherwise was kind of magically kind of ignored. So what happens here is we have to then the number that starts to go off the bond market and go into pure money printing, it's going to have one really big layer because of the deficit. And then another big layer is paying the interest on the national debt. And another really big layer will take all these U.S. unfunded obligations, Social Security, federal worker retirees, military retirees, and then they will end up needing their money, even if they're kind of trapped in treasuries. They're going to demand that they get the real returns coming out of those, and they're going to want that in the same year. And in this case, they'll be kind of forced to come out of money printing in order to make sure that they at least get the principal might be at risk and at loss, but at least the interest is coming back. The 3% or 2.5% will come back, and that'll go into some fund where they have at least some money. They'll kind of turn into real money they can actually count on and use. So that what's shocking here is you're talking about when we can't put the money onto the bond market increasing, we're talking about $9 trillion of money printing, and that includes one layer the deficit, one layer is interest on the national debt, and the next one and then the next one is in the next part is the U.S. government obligations and just paying the interest on that. Now, when we go rewrite size this column may well be quite a bit bigger, smaller, but still this number is so kind of like this number might even cut in half, but it'll still be such a big increase of money printing that suddenly the inflation rate will change. So what this is designed to do is the yellow column will let you, this is the big decision you got to make. First we'll have big discussions on wholesale replacing this number. That'll be a big strategic discussion, and we need the left and the right having that discussion. And then over here, the real focus decision you make after the fact is the 0% means all of that deficit, all the interest paid, all the U.S. government obligations would be returned goes into just growing the bond market. The 0% means it's 100% done on the bond market. When it shifts to 100% over here, that means it's 100% on the money printing is paying that needed money every year. And so what you can decide is, and we have a couple of different tabs here in the bottom, and you can come along and see what if we increase at a more blended rate. The issue is when it's growing exponentially, and it is, then the more you try to ignore it, it kind of goes into bonds where then the principal you have to pay back is growing exponentially. Then it becomes it's even a bigger problem down the road. When you go into money printing, you're really stiffing a whole bunch of people by paying them back when you deflate the value of the money. You pay them back, and they're getting cents on the dollar just because the dollar is now devalued. When they start to get that back, when that happens, a whole bunch of people across the economy get slaughtered by inflation, and including people paying the bonds. So, when that happens, then you have a lot of the feedback loops happening here. So we'll have big strategic discussions on these things. So if you have any discussions going on, please tweet about it, point economists to us, point people to us we should have discussions with. We'll make this available, and you can pour through this file. You can go make a clone of the file and replace the values as you think are appropriate. So we will wrap this up, and we very much want anybody, you can come into our subreddit. It's reddit.com/r/USD Project, and please post there, and we want to have a discussion back and forth. What are your thoughts on all of these issues? Well, thank you, everybody, and have a wonderful day. And we're going to have this podcast every week. It's currently scheduled on Wednesday at 9:30 a.m. Pacific. And we'll skip next week, but we hope to see you 2 weeks from now when we're back. Thank you very much. Bye.